This is class 2. Thank you for coming. If you haven't seen class 1, go check it out. I got my notes here. Feel free to screenshot them. I'm going to run through all of them so you understand all of it. But okay, so we're going to talk about support and resistance today. And everybody good? Can see my screen? Yeah. Okay. Make sure I can see the chat. Okay, cool. So what we're going to run through here is first we want to talk about support and resistance, the key points we want to go over. If you hear something in the background, it's my dog running around. But okay, so first thing we want to focus on key levels, meaning key levels are levels that are shown on the daily chart, the weekly chart, these bigger time frames where most people are going to see it. Not everybody's looking at the 5-minute chart. Not everybody's looking at the 15-minute chart or the hourly, but everybody's looking at the weekly chart. Everybody's looking at the monthly chart, unless you're a scalper. But we don't play that. We're looking for bigger moves. We want to find plays that are going to give us 200, 300% return. That's what we're looking for, and minimum of 50% return. So we want to play key levels, and we'll get more into exactly what a key level is. And we're going to run through that. Plenty of examples. If you have suggestions in the chat or questions, let me know, and I'll be happy to go through them. But so the first thing is we want to play key levels. We want to play strong levels. We don't want to play just weak levels that will get blown through in a second. We want to have something that's going to give us a really nice move. And so the next thing we want to do is obviously we want to wait for these key levels. I can tell you a lot of my losing trades, I actually looked at my trades this week, and I would say, I think it came out to be 60% of the losers I had. And 60% of those losers came from mid-air trades. So when I say mid-air, that means like a level is here, but I took the trade here just because I was impatient and wouldn't just wait. So now I know what to go into next week, and make sure you're doing your trade journal so you know what you're screwing up on. So because that's key. You got to know what you're messing up on and what you're doing right, what you're doing wrong. So that's the next thing. We just got to wait for these key levels to happen. And so the next thing is, yes, patterns are great. For example, the example that I was showing earlier when my screen wasn't showing up is, for example, here, we have a head and shoulders. So as you can see, we'll go over why this is support or resistance in a minute, but I just want to get the idea across. So basically, one moment. What we have here is a head and shoulders. So what that means is we got a head here, or a shoulder, head, and a shoulder. So this is a pattern. You can Google it. Look up on Google what a head and shoulders pattern is. We're not going over that. That's not the main topic. But the point I want to get across for those people that play patterns, you only want to play a pattern that's going to contain a key level. So like if you're taking a bear flag, don't take a bear flag in midair or a bull flag in midair. For people that know these patterns, you don't want to take those in midair. You want to take it around a key level. And so that's why I kind of shy away almost from patterns. Like they're extra confirmation, but it's all about support and resistance. That's all that matters that we're looking at. That's what you want to focus on. And that's what we're hitting home today and how we're going to execute trades within this. So wait for these key levels. We only take trades at key levels, and then we follow the trend at these key levels. So what I mean by follow the trend is like, you can see, I'll get a clean chart. You can see here how obviously for the past few years, we were making higher highs and higher lows on the S&P 500. Now, why in the world would you ever want to short this? Why in the world would you want to get in puts unless you're a shorter term and you're seeing a shorter term trend, like maybe like this, and you're trading on the hour time frame? But ultimately, when we have higher highs and higher lows, meaning when we pull back, that low is higher than the previous low, and the high is higher than the previous high. So what you want to focus on here is making sure that you're catching these pullbacks. You're catching these pullbacks on a higher highs, or you're catching pullbacks on a downtrend when trading the S&P 500. You want to catch the pullbacks and you want to follow the trend. So these levels, so if I just draw a few levels here, when you want to get into a trade, what you're looking for is you want to get in at these levels because they have some sort of significance. So you want to use that to your advantage and not just get into the stock at a random point. You want to get in at the best possible price so you can maximize your gains and minimize your losses, because this is basically a line in the sand. It goes over this, you're out. But if it goes down, it has potential of going all the way down here if it really wanted to. Your risk is limited because you're getting in at a good place, but your profit potential is unlimited. And so that's the point we're trying to get across here, is you want to take trades at those key levels. Okay, so how do we get these key levels, right? So we talk all about support and resistance and how we can get there, but we want to talk about, okay, how can we use these to our advantage? So we're going to walk through it a little bit. So we want to see a strong reaction, like a strong bounce or a strong rejection. We want to see some sort of strong movement that signals to us, okay, there's people reacting to when the stock gets to this price. A perfect example is QCOM. We went over this last week, but I want you guys to see the power of this. Okay, so, and I was just drawing this up earlier. Look at this. So this 123 level, look at the reactions it has every time it gets to this level. Okay, so I use this tool here to see what percentage it actually moves. So for example, here was a 20% move in the stock. That's easily 1,000% on an options play. No, without question. Okay, maybe 500% without question, but you get the point. So like, for example, every time it comes off, it has a strong reaction. So it comes down this level, pops up, comes down this level, pops up, comes down to this level, and then check that pop. Okay, now look at here. So last week I said, okay, it looks like it's setting up for the same, pretty much the same move. It came down, it held it. It faked some people out down below by going below it for just a minute. But ultimately, it had a huge move up. And it's like, even if you didn't catch this whole thing, like from here to here or here to there, if you caught just this move from 1 week, if you would have just got in where it was at, that support level was at, and sold at the end of the week, you got an 11% return or 11% return on the stock. $13 move, which comes out to be $600 about on whatever option contract. It depends on the option contract, but at the money contract, you're going to see a $600 gain on whatever contract you're in 1 week. So, or $600. Yeah. I said that correct. Okay. So that's what you want to look for when you're looking at this. So the next thing you want to look at is you want to see, so we see strong reactions to this level, right? We see that it has strong reactions, but now we also want to see, I forgot to even mark this here. There's another move. So we've had like 15 bounces off of this. You could have played this all year. So that's the point I'm trying to get across. We want these massive moves. Don't waste your time. Don't waste your time putting money into something that's on a 15-minute chart that's only going to give you 20% gain. Like, why wouldn't you want this? Why wouldn't you just wait for a 500% gain and you don't even have to sit in the market very long? This is a huge move in a short amount of time. So that's what I'm trying to get across. Put your money towards something that is worth your time. Okay, so somebody asked, how can you avoid those fake outs there, the false bottom? Okay, so personally, you can't. Like, there's not always going to be a time where you can. So that's where risk management comes in. So like, for example, if we drill down, so this might sound kind of crazy, but the way I would run trades like this, I personally do it, is okay, this is a weekly level, right? I'm not going to wait for a weekly close. If I see a 15-minute close below this level, I'm going to get out because it's going to end up being like a 10% loss. But if I get back in, look at this huge, like later on, I see it reclaims this level, comes back above, and it was just a fake out. I get back in, it's a 400% gain. Is it like it's worth my time to get out and be safe, and so I don't have to hope it doesn't go way down here and lose lots of money on my contract. Just cut the loss early because you can always get back in. Because if you structure your trades to be your losses are so much smaller than your winners, this is a huge winner right here. Just in these two candles, that's a massive win. So like, for example, if you go down to where this, okay, look. So here, if you would have waited for a 15-minute entry, you probably would have gotten in here. You probably would have got stopped out here. But okay, you wait the next time, and then the next time it reclaims this level and comes and look at that retest. Exactly what we want. It holds. Now look at in 2 days, or not, that's in 2 days. It's a 10% move in the stock. You're not, when you get back in and you see these gains the next day, you're not going to be worried about getting stopped out here, if that makes sense. So like you just, and look at, when you have this, that was a 10% gain in 2 days. What was the drop to the open? 2%. So you had a 2% drop versus the next day when you got in, you had a 10%, 11% gain. Like it's just, so that's the difference between betting. You're not going to lose 50-50. You're not going to lose exactly what you put in. You can make your losers small like that and then have these insane winners where it's going to take 15 losses to make up for this one great trade. And that, yep, exactly. You got to trust those levels. That's what you got to make sure to do. And personally, this is where I would have got it. Like this beautiful hammer, you would have been able to catch this move and you probably would have got out at around here just because it seems to be some sort of a level, but also it has a huge move in anyways. So like it's, so you could have played it here and then played it again. The funny thing is I played this on the downside and my contract went up 100% and I'd played the break here, which is a little more risky, but I didn't even continue to watch the stock to see what it did after. So that's my fault, but you know, you just got to set alerts and watch these key levels. Okay. So I really got in depth with that. But we're going to continue on. So I'm glad that I answered your question. Let me know if you got any more. But okay, so first thing is we want to see a strong reaction. Next thing is we want to see it act as support and resistance. So these two things I love about the levels, like the levels that I like the most is when I see these two things together. And those are the ones that are worth my time. So for example, acted as resistance, became support. So now you know this is a level on both realms. It was a resistance at one point, and now it's a support at another point. And now it's held as support ever since then. Now imagine when this thing drops. Imagine if this thing drops below here. That's why I took puts here. It's because the market looked bearish and it had this would be a huge drop if it was to happen. So I'm trying to think, okay, here's a good example. This level breaks. Look at this level that's been holding for years, ITNC or INTC. It's been holding it for years, holding it for years, holding it for years. As soon as it broke, look when it did break it. Sure, you had a little bit of a fake out, but either way, when it broke that move there, still you would have been out by then. It's an 8% move on a terrible moving stock. And same example here. As soon as it broke here to the next level, that's a 15% move. You're not going to get that in the S&P 500. It might be easier to trade the S&P 500, but when it breaks these weekly levels, you have some crazy moves. So that's the next thing. So we want to see it act as support and then resistance. So I'll show you a good example on SPY just because it's easy. Here's a good example. Okay, so here we see it act as support. We act as support, bounced all these times. 1, 2, 3, 4, 5 times it's bounced off this level. Okay, now you can see, look at how it reacted. It acted as resistance when the time came around. So you know this is a good level. That's what you want to see. You know this is a good level because it did both things and it had, what is this? A strong reaction, a huge reaction. This is a massive down candle. And as soon as it rejected that candle, look at the move it made. 13% in 2 weeks in the S&P 500. That's not normal. So you can find these levels in the S&P 500, and that's what I like to do because it's easiest to trade it and not worry about all these other stocks. But that's the gist of this. So basically, summing this up, have a strong reaction to the level and access support and resistance. People talk about having like a certain amount of touches. Sure, that's important. Yes, you want to have multiple touches, at least 2, preferably 3. I would say 3 as a rule of thumb, but these are the 2 things you want. These are the 2 things you want, and make sure. And then just keep this in your notes. Higher the time frame, the stronger the level. So we're looking at the weekly level or the weekly chart. These levels are going to be much stronger than a level on the 15-minute chart, or a level on the hourly chart, or even the day chart for that matter, which I pull most of my levels for, like day trading, things like that. I pull all my levels from the daily chart. I don't do it from anywhere else. I take all my levels from the daily chart. Now, if I want to swing trade, I'm going to be taking trades from the weekly chart, because those are the ones that are worth my time. Like, for example, this is what I'm looking at now. Okay, so look at the past few times it had a reaction to this. So here, look at the bounce it had. $90 up to 123. Okay, that has me interested. Okay, now look at when it acted as resistance. Look at the move it had. From $88 down to 65. Again, boom, not as dramatic, but these are still fat gains that you can make profit on. That is really good. Okay, but this is what initially caught my eye. Okay, so we had a bounce here. $90 up to 112, up to 108. These are $20 moves in this stock. It's a $20 move, which is over 20%. And I mean, a decent amount of time, but either way, patience pays. These are huge trades. This is worth my time, in my opinion. These moves are worth it here. Like this is worth my time, having a move like this. So the next thing we want to look at is supply and demand zones. I had somebody ask about the supply and demand zones. One of the things that we want to go over is basically what you want to look at when you're looking for a supply and demand zone is basically where there's chop. So for example, you want to see chop and then a dramatic move. It's the same concept, but it's just a zone. So you see how this is chopping around, how there's multiple candles within this. Like a good rule of thumb is 4 candles within the chop zone, and then there's a dramatic move that happens after it. That's the concept. So like that's one of them. I don't really use this that much, so someone asked me in the chat to go over this. But yeah, that's basically the concept. So you're looking for some chop, consolidation, and then a move outside of it. So that's the concept of that. It's similar to support and resistance. I don't like the risk to reward here, so I personally do not play it. And so next thing we want to go over there's 2 different ways people trade levels. So there's people that take breakout trades, which when we go for the example of QCOM, this is what we're looking for. So a breakout trade would be something like, okay, let's show one that actually paid. Okay, so this is a breakdown. So when this broke through that level, or well, this is a better example. This is a breakout trade. Somebody would buy when this trade broke this level, or this stock broke this level and held. They would take the trade to the next level. I do not do that. I like to see bounces. I prefer to play all these bounces here. The 1, 2, 3, 4, 5, 6, 7, 8, 9 bounces this stock had off this level. I don't want to play the break. I know the move will be big, and I'm sure that's great, but I'd rather catch the bounces or rejections of levels because they seem to be safer. They seem to be safer. And so that's what I typically like to look for. And so from there, we want to look at, let's see. Let me pull my notes back up. So that's what I'm looking for. So there's 2 types of traders, breakout trader and trend or bounce and rejections. I personally play the bounces and rejections because I think they're safer. I think it's easier to get within a trend by playing that way. We want to buy the lower highs on uptrends and the higher lows on downtrends. So that's how we want to trade. That's how I like to trade. And then wait for confirmation. So what you want to do is you want to wait for confirmation. You want to wait and see this thing play out and wait and see when you have a nice hold. For example, when you see a hold here on this candle or here, this candle, you see it come down and test this price, and then it gets bought up with a good wick, and a hammer candle. When you see it hold these levels, this is what we're looking for. When it wicks, when we have this nice long wick here, nice long wick, that's what we want to see. That's what we're looking for when we're trying to take these trades. So that's the idea behind that. That's waiting for confirmation. I personally will look at the 15-minute when I take these trades. So my confirmation here would have been this. When it broke back above, came down, tapped that level, and then held, that's the trade I like. When it breaks through, comes down and retests the level and makes sure it's all good, that it's going to hold it, that's what I like to trade. That's considered a bounce. Other people will take this trade where it breaks through. I don't do that. I stay patient because it's most likely going to come back down and retest the level anyways if it's a good breakout. And then the real move comes after that retest. So being patient pays. So that's the next thing we want to look at. Types of confirmation. This is something I went over the other day, or the last class that we had. Basically, if you just take a screenshot of these, and these will kind of give you the idea of what confirmation is. So these are the things you want to look for when you're looking for a bounce. These candles here, preferably, this is my favorite right here, a hammer candle. This shows you how the buyers are reacting to the level. Okay, so this is what I want to see as well. You want to see on a rejection. You want to see that long wick and a rejection there, and that buyers are stepping in, or that sellers are stepping in at that level, and it's rejecting that level. So when you see candles like these, like for example, this is a perfect example of a great candle that I would love to see after retesting a level. That's exactly what you want to see. Okay, you want to see on a smaller time frame. This is what I like to see. Same thing, a wick coming down and touching it, buyer stepping in. That's exactly what we want to see. Okay, so from there, the next thing we want to look at is, so these types of candles show you the reactions of buyers and sellers. This will just come with time looking at it and making sure. So these candles here can help give a bias of which side of the trade you want to take. But you also need to decide whether you're going to be a breakout trader or a trend trader or a trend change trader or more of a bounce rejection type trader. So there's either you play bounces and rejections or you trade breakouts. You're one or the other. And I prefer, like I said, the bounces. So from there, the next thing we want to look at is, if you're having trouble finding levels, use a line chart. So this just makes it a little bit more simple. I personally use the candles. I like it better, but I have heard a lot of people use the line chart to make it easier to understand and see. So basically how you do it on Thinkorswim is you would just go here, go to line, apply, and then we're going to look at it from here. So basically it takes out the extra noise. So you can see the level still kind of matches up that we already had drawn over here on the candles, but maybe just a little bit different we would have done it. So like maybe like there, that would have given a little bit better candle or better bounces and rejections there. And then we had another bounce here. So this just helps it make it more clear. This is more for beginners, I'd say. It just makes it easier to see these levels. Nothing really to this part. It just helps you see it better. If the candles are too much noise for you, I suggest going to this and seeing how that works for you. It works pretty similar. It just makes it a little bit easier on the eyes. Okay, so next thing we're going to be looking at is, that's mainly the informational portion of this. The last thing I want to say about like the educational part of this is, levels are used for entries. So where you're getting in the stock, as in being patient and waiting for those levels. Profit targets. So where you're going to get in and get out, and then stops. Personally, I just use my stops right under my entries. Like I'm taking it at a key level, so my stop is going to be right below that key level, and that's how I trade it. And so profit targets are a little bit trickier when you're day trading. It's a lot easier when you're swing trading because you're looking at a weekly chart, so you're going to take the levels from a weekly chart. But like I take, when I'm day trading, I will take levels, like basically ideas from the other charts and or from smaller time frames to take a trade. So like, for example, if I was taking a trade and just say for the sake of the example that there was a level here, or sorry, there was actually a trade that I took where the level was down here. And when I'll pull it up on here. So, okay, that's too much noise. We're just going to go here. Okay, so I had a level here and I took the trade down here, and I took it when I saw this red candle wick down here and give me confirmation. I'll make it bigger. At a wick, confirmation, extra confirmation, even more confirmation. It tested it 3 times, and that's when I got it. That's the trade I took. And my idea was I didn't necessarily want the full gap fill. I want it like where there's a gap from here to here. Typically stocks like to fill these gaps in the same day, if not on the same day within the next few days. So that was the trade I was looking for. It looked very oversold in the overall market, and I saw it holding support here. So this is what I was looking for. So I didn't want to wait for the whole gap fill. I waited because sometimes they fake it out and fill part of the gap. So what I was looking for was a move to here, just this low or this low here. And that's just based on your own intuition and what you want to do, but that's how you take profit targets. So that's basically what that looks like. So right now we're going to go over what we're going to go over now is we're going to go over examples with explanations from what to look for in confirmation, which we just went over. These candles on rejections, these candles on bounces. These are the things we're looking for. And then stop loss explanation. It's pretty simple. I use a 15-minute close under the level, and I like to keep my stop loss tight. So that's what I like to do. I use a 15-minute candle close under it. Even if it's a weekly level, I don't care. I want to get out of my trades quick. And if it works out, it's going to pay way bigger than the small loss. And I can always get back in. So then profit target, how we would take profit target, and then risk reward. Okay, so when we're looking at risk reward, what we want to see is the easiest way to do it. Let's use this example here. So when I got in, when I saw this, the candles wicking here, and I saw this was a good entry at a key level, mind you, I took this trade because it was at a key level that I already had plotted on the chart. And my idea was I wanted to take it up pretty much to a gap fill. So how do I determine what my risk reward is? So basically what you're going to do is you're going to take, what I like to do is an easy visual to do that is, okay, so this here, pretend this isn't here, that already happened. I'm just giving you an example of how I took this trade earlier this week and how it played out. Okay, so this green box here is my potential reward. This down here this down here is what I'm risking. So this is how you decide whether this trade is worth your time. So this is the risk I'm taking. If it comes down below here, if I usually like to set my stops at 20%. I don't like to lose much more than that. So I just keep it that way. And so basically this is how you make sure that you got proper risk reward. Okay, so you want to take this box and move it in here. 1, this is a rough estimate, but stick with me. 2, 3, 4, 5, 6, 7, 8, 9, almost 10. So basically this idea here is that I'm risking 1 to make 10. So this is what I'm looking for in a trade. And this is the exact piece you want to pay attention to and make sure you have down, because this is all trading comes down to. You need to have a good risk reward and make sure that this trade is worthwhile. that like, I'm okay with losing this much because I have the potential to make 10 times the amount I could potentially lose. So that's how you want to think about trading. And if you do this 10 times over, okay, you have one winning trade out of 10, but you have this risk reward every time. It's going to take 10 losers to wipe out your one winner. And it's, unless you know nothing about technical analysis or the market, and you just have a little bit of knowledge of understanding this, you're going to be able to be a consistently profitable trader if you understand risk and reward. That's all it comes down to. So let me know if you have questions on this part, risk reward. That's what I'm looking for initially when I get into a trade. First of all, I see it's at my level, right? Is it even worth getting in? Is it worth my time, my money to risk on this trade? Is it worth it? So that's the next thing I look at. So that's what I want to pay attention to. Okay. So, and then so we went over, basically that's one example of how I take a trade. Okay. So let's take an example of something that we can actually use now. Let's go back to the PM example. I got a couple more examples that we can run through, and then that will be it for tonight. So what we're looking for here is we got this weekly level that we already discussed. And I like the way this reacts every time it comes down to this level. When we had this level bounce here, it had a huge move. And then every time it came up to it and rejected it, it had huge moves. So that's what we're looking for. And then same thing here. We had huge moves every single time. Huge move. Okay. And now we're starting to have buyers to step back in. The stochastics is starting to look good. That's what we want. Okay. So now our idea is we're going to get in here. Now let's take our risk reward. So say we got a 20% stop loss, give or take. That's what this would look like. It's pretty similar. If you have Thinkorswim, it'll actually show it on your chart. But okay, so we go here. Potential reward. Honestly, I'd probably take my first target here because if you look here, we got some sort of support here. So maybe let's just say that's our first profit target, right? But if you have more than one contract, you can look for a move that's much more significant. So maybe something up to, honestly, I would let it ride up to here. That's what we're looking for. So you have that there. And this is all the potential move that you have. 1, 2, 3, 4, 5, 5 to 1, roughly. You're risking 5 to make 1, or you're risking 1 to make 5. That's worth your while. This is going to make this trading like this in this pattern at these key levels, waiting for confirmation, picking your profit targets, and then making sure the risk reward is worth it. And that's going to keep you consistent and can make you consistently make money. That's all you got to do. So that's the keys. That's the keys to it. So if we outlined it and walked through each thing, what we look for is 1, have a key level that you're going to be trading. 2, you're going to wait for confirmation. I like 15-minute and above, or even the hourly is good as well. Okay, and then the next thing we're going to pick is our profit target. And then make sure the risk reward is there and worth your money. So am I going to be able to at least make 100% on this play, 50% on this play? If I'm risking 20%, I want to make at least 50%. That's the thought process behind this. So that's why we want to take a trade like that. We'll go through one more example that I saw when I was looking through charts earlier that I like. AMD. Look at the moves that it's had every time it comes down to this level. Bounce, bounce, bounce. It has yet to break through this level. So I have pretty strong confidence that this is going to make a move to something a somewhat significant move. So say if you bought in right where the close was, right? And your stop is right below. we're looking here. Oh, sorry. We'll go red. And then, okay, so our profit target would probably be here. Because you can see, hold on, I'll show you why. We have a level here. Maybe right there. I probably would like it. Okay, so that's what we're looking for. So is this worth our time? 1, almost 2. Not worth our time. That's the thing. That's the point of this. You want to look at this and say, okay, is this even worth our time taking this trade? Probably not when you look at PM. When you look at PM, a move from here to there seems a lot more enticing than AMD, where you're barely making a 2-to-1 risk reward ratio. So that's the idea behind it. If you guys have questions about charting stocks and basically finding support and resistance, if there are good support and resistance levels, let me know, and I'll be more than happy to help you determine whether they're a good level. But make sure you have those 2 keys in mind. You want to see them act as, let's see, where did I put it? You want to see them have a strong reaction to the level. That's the first thing. And then you want to see it act as support and resistance. Those are the 2 things you want to find. And keep in mind, the higher time frames have more value. So those are the things. That's how you're going to execute a trade with these. You're going to wait for you're going to find the key levels. You're going to chart those out and get good at finding those. You're going to wait for confirmation and then wait for a 15-minute hold or rejection, whatever the trade may be. You want to wait for that confirmation for a 15-minute candle or above, an hourly, 4-hour, whatever you want. And make sure the risk reward. Okay, someone had a question. I might get cut off when I'm answering this, but I'm still new to options trading. Since we're pulling out the chart, doesn't it mean we should buy a put or call? Yes, a few weeks out. Yes. So that's exactly. So depending on what time frame you're looking at, this is a weekly chart. So each candle that has a reaction here, that means each candle means 1 week. So that's 1 week, that's 1 week, that's 1 week, that's 1 week. So like all in all, these are 4 weeks. This is a full month right here. These 4 candles, that's a full month. So if you want to find something, if you want to drill down, you take the level from the weekly chart because it's stronger, but you want to find your entry on the daily chart. You could have saw, okay, we had this nice bounce here, and that's maybe when you would have got in. And that's when you would have taken the trade. So you can buy, I would recommend buying a month out at least if you're taking it off the weekly chart, if not more than that. You're looking at the daily chart, I would say a month out is definitely sufficient if you want to catch the full move. You don't have to always catch the full move. But I hope that answers your question. Yep. No. Buying more time just adds to your safety. That's pretty much it. It just adds safety, and there's really no reason not to do it, to buy more time. It keeps the trade safer. Well, that's going to wrap it up for me, guys. Thank you guys for coming. We're going to have a webinar next Sunday, as always. No problem. I'm glad I can help. Thank you, guys. Let me know if you have questions in the chat. I'll see you guys next Sunday at 8 p.m. Eastern time.